Good, good evening, ladies and gentlemen. This is Barry Norman on behalf of Alvexo, powered by investing.com tonight, and welcome to our webinar on trading the economics calendar or making profits trading the news and the economic events. Now, tonight's class is sponsored by Alvexo, one of the world's leading Forex providers and brokers. They are a regulated company, and as you see on the screen, their license number is up there. They are regulated and one of the leading Forex brokers in the markets. They offer many ways to trade on their platforms. You can use their web trader, get real-time quotes, one-click trading, all the order types, and high-speed execution. Or you can use their MT4 platform to use AEs to build your own trading robots, to build your own automated trading systems, right on their MetaTrader 4 platform. Do all kinds of multiple order execution, and you get the most advanced charting system in the marketplace today. You also will get free signals from Alvexo twice a day, giving you alerts to what is going on in the market and what assets are moving. Now, there are many ways to position yourself prior to an economic news release or an economic event. And all of us out there want to know where to get this information and this data from. How do we do this? But the economics calendar, to a lot of new traders, surprises them. They don't realize that there's a tool out there that gives you all and tracks all the economic events happening around the globe. Now, the economics calendar is published daily and is updated through live feeds continuously. And the economics calendar does not analyze data. It reports straight figures to you. So that means you're getting the same data as a big JP Morgan Chase or a big central bank. You're getting that data almost within seconds of the time they get it, and you're getting good, clean numbers, because what you're getting is the actual numbers that are released, not somebody's take on the data. And all the data that comes out to these calendars is virtually the same, because they all come from data feeds from either government agencies or some of the big reporting agencies like Platts and Thomson Reuters. Okay, and these are the ones who collect and do non-governmental reports. But the information is programmed months in advance, and that's the nice thing is you can look at the calendar a week ahead of time and prepare yourself for the events that are coming out. Now, on your screen, this is tomorrow's calendar. This is the events that are important on the calendar. Now, if you don't know how to properly read the calendar and use it, I'll take you back over. Let me take you to live calendar. Let's go back over how to actually read and use this calendar before we look at just tomorrow's events. Now, what you have to understand is almost, I'm not going to say every one, but almost every calendar is identical, releasing the same data. Okay, because this data comes from feeds from the government agencies, there's not much that they can do to change it. All data is based on a three-tier system. All data is rated. First tier, second tier, and third tier. Okay. Top tier or third tier is the most important data, and it will have an effect on the currency and the commodities markets. Okay. Now, remember, these economic events were not developed for Forex traders. These are economic data that every country around the world releases, and that is important for many, many reasons to lots and lots of people. So it's not that they are just put together for us, but the rating system has been put together for investing and trading. Okay. Because some of these events, okay, like a healthcare survey, isn't important to you and me and isn't going to affect the way an asset trades. But if you're in the healthcare industry and the government's releasing this data from the Department of Labor, it's crucially important to you because of the type of business you're in. Or if you were trading a healthcare stock, it might be important to you. But it doesn't have importance to the movement of a currency or a tradable asset. So hold on, let me pop up today's calendar from investing.com on your screen. So we're going to be looking at a live calendar. There we go. It'll be up on your screen. There we go. And this is today's calendar on investing.com. Now, the first thing you should always do when you're using your calendar is look for filters and times. First thing you want to do is you want to make sure that the time of the calendar is set to your local home time, because you don't ever want to miss an event because you calculated the time incorrectly. Okay. You also want to find filters, because all the calendars give you ways to filter out the data, because there's huge amounts of data coming out every day from every country. And the fact is, unless you're trading something out of Costa Rica, you don't need to see Costa Rican data or Cyprus data or Malta data or Taiwan data. But if you happen to be trading something out of those countries, you're trading some exotic currencies, you might want to see those. So you decide what country's data you want to see. You also decide to see what type of data you want to look at. Okay. Now, all calendars, whether it's investing.com, Forex Street, Forex Factory, MarketWatch.com, Wall Street Journal, they all have the same basic setup, the same filters, because they're giving you the same data. Okay. So what the difference is in a lot of cases is the graphic designer's ability to design around the events. And you'll see, like on investing.com, they use bullheads for importance or impact level, where some places use stars, some places use color system, but it's still a 3-tier rating system. Now, I filter down all the events that will affect the major currency pairs. I've taken all of the events, all the countries, and I've only clicked off level 3, the top tier events. If I was going to click off 1, 2, and 3, it's so much data that you can't even absorb it. This is just for today. And this is only for a couple of the major countries. Now, some days, this calendar goes on for 2 and 3 pages. But because I'm only concerned with the ones that will have an effect, a tradable effect on the markets, I'll leave off the level 1s and just stick with the 2s and the 3s. So to learn to read the calendar is quite easy. Most calendars start out in the same order as this one. They give you the time of the event in your time zone. They'll give you the country and the currency for the event should affect. They'll give you the rating system. And sometimes some graphic designers move it to this side, some leave it over on that side. It's the same rating system. Here, investing.com uses bullheads, and they claim here it's one bullhead is low volatility, although up here they abbreviate it as importance level. Then it's medium volatility and high volatility. Okay. In essence, they're called tiers. First tier, second tier, third tier. It classifies how important the data is to the economy of that country. I'm just trying to get some of my markings off of here for you. Okay. Then we're going to go over to the name of the event. And if you're just starting to use the calendar, sometimes these events can be confusing. But after the first month of using it, because all the countries release the data over and over, that once you've used it for 1 month, you'll get it down pat, because every country in the world releases the same types of data. They just call it something different. So in other words, the jobs report out of the U.S. is called the non-farm payroll report. The jobs report out of the UK is called claimant count. The jobs report out of Australia is just called the jobs report. So after a while, you'll get to know exactly what they are. So we can see this morning the first data event on the calendar was BBA mortgage approvals. That's the British Bankers Association. Okay. So after a while you get to know that, but you don't have to, because every calendar will either give you a hyperlink or a little box that will open up a window that will tell you exactly what that event is. Okay. So this tells us the British Bankers Association mortgage approvals measures the number of new mortgages approved by the BBA's backed banks during the previous month. It'll even tell you the higher than expected reading should be taken as a positive or bullish for the pound, while a lower than expected reading should be taken for bearish for the pound. Okay. So it gives you some general understanding. Now, investing.com gives you some bare basic charts afterwards. Now, for some of the most elaborate charts, FX Street has some incredible charts associated with projection of market volatility, what assets should be affected. They're really quite nice. But you can decide which ones work the best. But when you're new, and this is important to look at these two charts, because you have no idea what number should the BBA come out at. What number does it average? Like, would you have any idea that the U.S. sells 1.5 million homes a year, while the UK only sells about 33,000, and Australia even less? So you have to have some basis of understanding. So these two charts will tell you exactly what area. So we can see the BBA mortgages come out about 40,000 mortgages a month. Okay. We can see the swings of the mortgage. We can see they've been staying pretty steady overall for end of 2016 and into 2017. So we can see how that event is shaping up. So we got that all by going to the little hyperlink over here. Now you have to learn to read the results, because before you can make any trading decisions, you have to understand what these results mean. So first we're going to start off with the previous column. Previous is simply the data that was released, the number that was released the last time this report was issued. So if it's a monthly report like BBA mortgages, it's the number that was released last month. Then we come to the forecast. The forecasts usually come out about a week ahead of time. This is where you will see some type of variation between calendars. The reason being is most of the releasing agencies or the government agencies that collect this data do not predict what the markets will expect. They just release the data. So there are different forecasting agencies. Like sometimes you'll read in Bloomberg and say, Bloomberg survey of 36 economists predict that we should see a report tomorrow at 40.8. Where Reuters will say, our in-house survey showed we're expecting 40.79. But the fact is, these forecasts are so accurate that the markets have accepted them as being becoming the market expectations. And then when the data comes out, we actually get the results here. And to help you understand this and how you might decide or why you might want to trade from these, let's go back to my PowerPoint, and I'm going to tell you a story. And then we'll go back over and we'll look at what happened today with the big event on the calendar today, which was UK GDP. And then we're going to look at tomorrow's calendar to see what big events we have scheduled tomorrow. So let's go back to my PowerPoint. And I'm going to tell you a story about your kids and their report cards. Okay. Now, you're sitting down to Sunday dinner, and you say to your son, well, kiddo, report cards are due on Wednesday. How do you think you did? Because an economic event is like a grade for the economy. Now, he says, well, Mom and Dad, if you remember right, last semester I brought you home 4 C's and 4 C pluses. They said, yup, we remember. They said, well, how are you going to do this semester? He says, well, I think I did a little bit better. Maybe I'll bring you home 6 C pluses or maybe all C pluses. Okay, well, you're good parents, you have a good kid, and because he's pretty honorable and he's pretty straightforward, you take him on his word. Now, of course, you don't go to the school and talk to the teachers. You didn't do a survey what the other students got. You didn't find out there was a new principal who changed the grading scenarios. Nothing. You didn't do any analysis. You're just collecting data. Now, because you're good parents, you do your little thing about lecturing them. You know, if you want to get into university, you have to get better grades, maybe a little less time in soccer, maybe a little bit less time on Facebook, and a little bit more time studying. But he's a good kid. So come Wednesday, he comes home with his report card, hands it to you, and the envelope goes right out the back door to play soccer. You open up the envelope, and he brought you home all B's. Well, you're thrilled to death. So you open up the back door, you holler outside, say, as soon as I get the house ready, we're going to go over to the mall. We stop out at the Chinese place you like for dinner, and then I'll take you over to the sporting goods shop, and you can get those, those Nikes you were looking at. He says, thanks. You're all happy. Why? Because he did better than your expectations. Not better than last semester. You didn't rate him against the other kids at the school. He did better than what you were expecting, better than what he forecast and what he told you at dinner. Because if he told you at dinner he was going to bring you home all B's, you wouldn't have been as excited because you would have adjusted your sentiment based on what he had told you. But because he did better than you expected, better than the forecast, you had a very positive reaction, an overly positive reaction, almost a knee-jerk reaction. So now what happens is you're getting ready to go, and the soccer ball comes through the picture window, breaks the window, shatters the glass all over the living room, and you're mad. Okay. You holler out the back door again, tell him to get his butt in the house, clean up the glass. You're not going to the mall, you're not going to Chinese, and you're not going to get Nikes. And this is what happens in the market. Okay. Within no time flat, some other event can happen that could ruin the elation from the previous event. But after you get past the glass cleaning up and everything is straightened up and everything's good, the kids apologize, you still go back to being happy about all those B's. So you set a new level. So this is what happens in the markets. When the results are much better than expected, they can cause a volatile reaction, and they can send that asset also to find a new trading level even down the road. Now, believe it or not, there are a large number of amateur traders who ignore news events and economic releases completely. They concentrate solely on technical indicators and chart patterns. Then they wonder why the market spiked violently against them in the space of a couple minutes. Now, the thing is, whether you're going to trade from the calendar or not, no matter how you're trading, you need to be aware of these events because they can send the markets crazy. And you could have had a great trade all lined up, but for that few minutes, the market volatility got crazy and you got stopped out, because you didn't see that there was an event on the calendar. Now, other traders acknowledge the importance of news releases, but they see them as unpredictable and too risky to trade. For the most part, they have been taught to trade during quiet markets and always be flat whenever a big news release comes out. If you're not sure what to do, that is one of the smartest guidelines you can follow. But there are ways that you can trade economic events to successfully make profit without getting yourself in high-risk scenarios. In fact, some of my best trading wins have come from reacting quickly to big economic releases such as the U.S. non-farm payroll report and the Fed rate hike. And as I've previously spoken of the importance of buying the rumor and selling the fact, in effect, anticipating the news releases before it comes out is very good. In my view, news events can offer low-risk trade setups so long as you are aware of three things: the market expectations running up to the event, what is priced in and what is not, the likely reaction from different outcomes, and the best way to play those outcomes. Now, trading the news is harder than it may sound. Not only is some reported consensus figures important, but so are some of what's called the whisper numbers and revisions. So revisions we have to talk about. Revisions, when we look at the calendar, let me pop you back to the calendar, are adjustments to the prior month's reports. So as you can see over here, we see in the previous BBA mortgages, if you see red in the previous, means in today's release, they also downgraded last month's report. Because not all the data comes in on time. Sometimes other data is collected after the initial report comes out. So they must change the previous report. So they issue what's called a revision. And it's very important that you're aware of these revisions, because those revisions can have an effect on the market reaction to the data. Because say, for instance, BBA mortgages came out right where they were forecast, but we also saw we had a big drop of last month of 0.2 thousand, or that's 200 actually applications. Now, that is significant because the actual event didn't come out much better. It didn't come out better than forecast, and you didn't do as well before. So in our calculus, we call this a bump, because this bumped down the results of this report. Now, the big event today was UK GDP. And this is a very clean-cut, easy one to teach from tonight, because what we saw was the previous was a 0.3% for both the GDP yearly and quarterly. We were expecting 0.3 today in the forecast and 2.1 in the annual. And what happened was both of these, and this is one report with two different sections, both had significant misses. So what do you think happened to the pound when that report came out? Okay, anybody know? Well, let's jump up and real quickly, I got it already up here for you. But let's take a look at what happened to the pound today. Let me just get my markings off the screen. So this is where the pound was at the time of the data release. That data release sent the pound tumbling. The pound's been down all day, and it has not been able to recover ever since then. Now, there are other events, and there were some U.S. events that also gave the dollar a little bit more strength. But the reaction from that pound over the next few hours was negative. So when you have a major event that has a serious miss or a serious better, there's a possibility that you can trade it successfully to make profit in the particular currency that that's affected. Now, if we understand what this report's telling us ahead of time, we can build what we call a trading matrix. This matrix will determine what we consider market neutral, which is the zone around the forecast that if the report missed or it was a little bit less than or a little bit better than, would not be a tradable effect. I mean, it might send the pound moving, a point or two, but not enough that you could trade it. Not enough, but it's not enough that it's going to guarantee movement in that direction. Then you have what we call market neutral. That's market neutral. Then you have what we call market plus, which is a report that's so much better than expected, it's going to send that asset climbing. And then you have market negative, which is so weak, it's going to send that asset falling. But then you have to take into account the previous revisions, and that's what we call those bumps. You also have to be aware that many of these reports have secondary reports that are part of them, or they have two primary, or what we call headline reports. So we can't evaluate the quarter over quarter and the annual at the same time because they came out simultaneously, but we can't factor them in together. So if we had done some studies, we would have found out that quarter over quarter is the most important event. So we would have first built our matrix around this event, and then the secondary event is what we would call bumps. So this report, the first report came out very weak and would have been in our market negative category. And then the next report that was part of it came out even weaker. So it would have bumped it farther into that weak position. That would have told us the pound would have fallen. So we have to be able to build this trading matrix. Hold on, let me bring my PowerPoint back up here. Okay, so what we do is we want to be able to build what's market neutral, market negative, and market positive. So let's take a look at tomorrow's events, and let's just take one event. Now, we're not building this to tell you to go trade an asset. We're building this so that you understand how to evaluate these reports. So let's go back to tomorrow's calendar. We're going to change it only down to 3-tier events. And we can see tomorrow there are two, actually I'm going to leave it on both 2 and 3 because there are some subsection reports from the durable goods report. So we're going to use tomorrow the U.S. durable goods report. It is a crucially important report in the U.S. And it's all the value of all the manufactured goods that are considered durable goods. Durable goods are things that last a few years or more, like washing machines and dryers, refrigerators. It's not about clothing and things you're buying, in the grocery store. So if again, we can pop up the explanation. It's going to tell you durable goods orders measure the change in the total value of new orders of long-lasting manufactured goods, including transportation items. So that means cars, boats, and airplanes are calculated in here. So this number can be easily skewed because a couple jet planes are very, add a lot of dollars to this report. So we also have a secondary report, which is the one with the 3 bullheads, which is called core durable goods. Core durable goods simply removes from that change transportation items. So it's taking those big ticket items out. So you can actually see the value of things like I said, washing machines and dryers, refrigerators, television sets, computers, things that people and companies are buying that aren't capital expenditures or big ticket once in a while items. So we can see tomorrow's report on core durable goods is expected at 0.5%. We can see the previous was at minus 0.2%. Okay. Now we at this point don't know much about it, so we're going to click on and get an explanation about, or we're going to go look at the charts and see about where this report comes out at. So the first thing we can see is it's all over the place. Last month it had a very big negative event, but we can see that it's been up and down all over the place, but it It reports in small increments, okay, in tenths of a percent. But it doesn't seem, it seems to be quite volatile. It has hits and misses with lots of revisions. And we see every month that we had a red or a missed report, we had a nice sizable revision because it meant most of the times the data didn't come in from this information. Now, we need to have some understanding of what we can expect. We can see in the past when we've had expectations, it seems like the expectations are usually about 0.5, 0.4%. It seems like it has big misses and big hits, and this is what we have to figure out, is what the range around this number will be that we won't have a big effect on the US dollar. Okay. Now, that's going to be a problem because it also comes in very small numbers. So we're going to have to, and the only way to do this is to guesstimate. I've got students who add and divide and multiply, and there's nothing you can do. Okay, you need to use your own acumen to build what we consider the market neutral territory. Because the worst can happen is if you have the territory built too big, you miss a trade. That's it. You don't want to make it too tiny because you don't want to go and say, oh, that was a really bad event when it really wasn't. So we're going to say that if it comes in from 0.4% down to 0.6%, okay, that is a market neutral event. Anything below 0.4, we're going to say is market negative. Anything above 0.6 would be a very big positive. So now we have that just a beginning. Now we also have to be able to take into the regular durable goods report. But we can't build this trading matrix. What we have to do is we have to wait for this to come out. And if this is better or worse, we just simply take a bump in the direction in which it went. If it's better, we bump it up. If we bump it into the better than expected range. If it's worse, we bump it farther into the negative range. So in other words, if this report came out tomorrow at 0.6, but then we had the regular durable goods and it missed, it would push it back into market neutral. If it came in at 0.6 and this report came out really better than expected, it would push it farther into market positive territory. Then we have to do the same thing with revisions. If we have positive revisions, upward revisions, it would give it another bump. So technically, you could get a bump here, a bump here, and a bump here. If you got a revision up here, a revision up here, and a good number here, and this came in at 0.5, this could have bumped that whole thing from market neutral all the way over to market positive territory. But when it does that, you can say, fine, it's in market positive territory, but you're not going to have a knee-jerk reaction to that. So what you're going to find is that you're going to find the euro US dollar or the US dollar pound or whatever the cross currency you're looking at, just gets a little bit, the dollar gets a wee bit stronger, finds a new level a little bit after this event. But you also have to be aware that we also have GDP coming out tomorrow at the same time. Separate report, but can have also another effect on the markets. Then we have some breathing room up into 1400 where we have an important Michigan Consumer Confidence Report. But this will allow you to start building our trading matrix to make some decisions. So we would just simply fill in market neutral. From there, we'd fill in what we consider market negative and then market positive. And then we would look at our bumps and see where we end up. So you've already decided what your market neutral, market positive, market negative territory are. And then as the results are coming out, you're either clicking a bump, clicking a bump or subtracting a bump, and you've already decided ahead of time what asset you're going to trade, if it comes out and what level it comes out, what you're going to do. And then you're just dropping things in here into this calculation, into your little matrix, and within minutes of the event, you've already decided what you're going to do. Now, you could be a short-term trader and want to just trade the volatility, or you could wait for it to go end the volatility, the initial knee-jerk reaction, and then go in to trade the dollar going up. So it's for you to decide whether you're taking the long-term or the short-term. But there are different ways that you can look at these. I'm sorry. Just let me get my markings off of here for you. Okay, so first of all, markets move a lot more in line with what the expectations are for a coming economic news release rather than what the actual news release implies. Meaning because traders trade their beliefs about upcoming news events, often when the crucial event or news release happens, the move is either over or ready to come roaring back in the opposite direction. And that the actual news report, opposite direction news report replied. This is why you may have heard the story, buy the rumor and sell the fact. So this allows you also to see where the assets or see where the market's taking place. Like before the Federal Reserve meeting, or like on Wednesday when we had the Fed meeting minutes come out. Before that event happened, you could have seen trade prices move into dollar and gold as traders were positioning themselves ahead of this release. So you want to be aware of that, because if there's too much positioning ahead of the release, then what you're going to happen is that release comes out at, or worse, it's going to blow off what the markets were, and the markets will readjust. So when a major report comes out and misses or exceeds expectation, there is an instant knee-jerk response. Then the markets will then correct and then adjust to its new level. Hold on one second. So when the economic data comes out, markets can react violently as traders enter and exit positions based on new information. Some news releases are more important than others. And this is what you have to do, and this is why you can look at that calendar a week ahead of time. Not to determine the top tier levels, but how important they are, how they've traded, and how the market's reacted in the past. That means on Sunday when you're sitting home and the kids gone to bed, you got a couple hours free, you can do all your research ahead of time. Okay, and that means when this event's due to come out, yeah, sure, you're at work, but you already have your matrix built. You got it on your mobile device. You got it already. You see what the event comes out because you're getting it released right through, investing.com's mobile device is just, popping it right up there, giving you an alert. You've already decided ahead of time what you're going to do. So all you do is you go in real quickly and set that trade up. Or if you took a position ahead of time, you now know what, you want to exit or you want to stay back in the markets. Or if you're looking for a longer term entry, you've decided all that ahead of time. Okay. So all of this is easy for you because you can quickly initiate the trade from your office while you're busy doing other things. So there are many ways that you can trade this for profit, but it does give you the advantage. It's one of the few times that you have actual time to do research and understanding and figuring out what you want to do ahead of time without having to go into a mad panic at the time something is happening. So this is nice time. It gives you the chance to be an educated trader because you know ahead of time what your previous was, you know what your forecast is, you know what your expectations are, and you've done your research. All you have to do is be ready for that event when it comes out. And then you can be prepared to trade it successfully. So, and the nice thing is all these events repeat themselves month after month after month. So we're starting June. Don't trade them in June. Build your matrices. Get to know them. See how they act. See how the market reacts. Then in July, when they come around the second time, maybe trade them on demo. Or maybe trade them on paper. Set up a demo account with Alvexo and trade them there. And then 3 months from now, when you have them down pat, you've gone through them a while, and you understand what they are and understand the ins and outs of each event, then and what assets are, like, down a while after, you'll know Chinese events have a bigger effect on the Australian dollar and New Zealand dollar. You'll understand what affects the Canadian dollar because it's a commodity currency. And you'll be ready to trade these properly because you would have had the time to learn them, because they do repeat month after month after month. Okay. And that's the nicest thing, is it gives you the ability to have a learning curve without risking any money. It's just a matter of putting in a little bit of time and effort at things that you can understand, things that aren't complicated, not technical analysis, not formulas. Just watch the events, build your matrices, use your common sense, your common knowledge, and sit back. Watch it for this month. Watch it in June. Watch it in July. Be ready to start trading in August. Well, August is a quiet month anyway because summertime. So be ready. September's non-farm payroll report is one of the biggest events of the year. You can be ready to trade that event and make profit there, and then trade event after event after event. There's many events on the calendar every day. You could spend your whole entire day trading just economic events. So it's a great way to trade. And like I said, give Alvexo a try. Set up your demo account there. Trade it there for a while on demo. Get it down pat, and then go over and start with real money. So thank you very much for joining us tonight. Remember, tonight's class was sponsored by Alvexo at www.alvexo.com, and we're powered by investing.com. And give both of us a shot. Thank you for participating, and hopefully you learned a little bit tonight. Take care and have a successful trading week. Good night now.